Welcome everybody to Decision Analysis and Data Science and Financial Innovation. A couple of faces you haven't seen up here. I'm Sheldon Bernard. I'm principal of a firm that I started not that long ago called A440 Management. Really, it's combining principles of DA, complexity theory, and post-Keynesian economics. It's just a fancy way of saying economics that makes sense and considers debt and considers markets as an interaction of human beings and not calculus. And I'm joined on stage by Stephen Malinick, who you've known. Third time is the charm. This is going to be an awesome session with Stephen. And somebody who you may not have met yet, Tom Kalin. And Tom is managing partner of Kalin Reed's Partners, which has helped over 100 venture-funded and mid-market life sciences companies with strategy and business development. Tom was previously worldwide managing director of the Strategic Decisions Group. He headed up its London office and founded its life science practice. Tom led client engagements that ultimately led to his co-authoring the very seminal HBR article, How SmithKline Beecham Makes Better Resource Allocation Decisions. Many of you have probably read this. I use it all the time. Thank you, Tom. At this conference, he wears multiple hats. As general partner of multiple real estate investment funds, he will bring real-life experience to this panel discussion. As mathematician in residence at SmartOrg and chief research scientist at probabilitymanagement.org, he will introduce us to his new family of probability distributions, the meta-logistic distributions tomorrow. He's a fellow of the Society of Decision Professionals, a founder and director of the Decision Education Foundation, and like so many who have been on stage, holds his degrees from Stanford, including a PhD in engineering economic systems. Please welcome our panelists. So I'm going to jump right in here. Tom, you and I have talked a bunch of times as we were preparing for this, and I understand that you are involved in a real-world intersection of DA and finance in conjunction with the FDIC. Can you tell us a little bit about that?
Sure, I'd be happy to. Some partners and I, with a small amount of money, started a small firm in about 2010, and this was right on the heels of the mortgage crisis, and we bought up a few residential mortgages with the idea that we could do something better. We could still make some profits for investors, but also be able to treat people well, people who would be otherwise thrown out of their homes, and a lot of the big players weren't doing it that way at all. Shortly thereafter, there came an opportunity. The FDIC put on the market for public auction, it was FDIC Residential Pool 2010, 1,500 residential mortgages, and they put those up for public auction, and my partners and I got together and decided that this would be a great way to build our business, and we would at least consider making a bid. So we had two very big decisions here. One was, should we make a bid and how much? And the second one was, if we won the pool, how would we work through and exit all of these loans? And it turned out that there were massive learnings in retrospect in both of these areas.
Can you say a little bit more about the bidding decision, kind of the approach you took, and what was the outcome of it? What learnings did you have?
Well, in the bidding decision, first of all, this was a pool of cats and dogs of loans. It was performing, it was non-performing, it was first mortgages, it was second mortgages, it was everything left over that the FDIC couldn't otherwise package and put into some kind of a mortgage-backed security. So there was a high level of uncertainty about what this pool of loans was worth. And so we proceeded as any good decision professionals would. We started trying to, the one sensitive variable in how much you bid in a pool of loans like this is exit proceeds. What are the loans, what will they ultimately yield? And so I worked with my very smart loan knowledge team in San Diego, and they could take these 1,500 loans and put them into 250 some categories, but they said, if you make the categories fewer than that, then it's apples and oranges. We can't tell you much about it, okay? So we lived with the 250 categories, and we did our best 10, 50, 90 assessments, for each category of the exit proceeds for that category. And then, with a bit of correlation of these variables, you can't solve it with a decision tree, but you're trying to add up 250 uncertainties, basically, with some correlation built in. And we did that with decision trees. We assigned 3-branch trees, 10, 50, 90 to the, 30, 40, 30 probabilities, just as we would in decision analysis. And if you'd move forward one slide, we came up with the red curve that is shown there, okay? And that red curve says, among other things, that there's nearly a 0 probability that exit proceeds would be less than $160 million for the entire pool. And my team of experts in San Diego immediately pushed back on that. They said, with this pool of loans, with this amount of risk, there's got to be probability that these loans, we could envision 155, we could envision 150. I mean, come on, there's something wrong with the analysis. And I just said, well, it's all the best information we've got. And we have worked through it really carefully. We've done our debiasing. Well, then along came the insight. We had modeled this with 3-branch trees. And so I went back, and instead of modeling the 3-branch trees, I took the same 10, 50, 90 ranges, but put them into metalog distributions, or actually a precursor of the metalog distributions, where you could get a nice, smooth, continuous density function for each of these loan segments. But that smooth, continuous density function, of course, includes tails. Ran the thing again, and all of a sudden, we've got the blue curve that has the tails on it. And everybody is suddenly agreeing, now that is a pretty reasonable representation, okay? So we learned something huge from that. If you just blindly apply what would be our typical decision analytic methods, you could end up with a very wrong representation just by artificially cutting off the tails. And in this case, had we believed that red curve, we would have made a bad decision. Why? Because I had other partners that were general partners of this fund who were basically saying, look, you're showing me the curve. If the chance of being less than $160 million is 0, we should up our bid by many millions of dollars here. And they would have won that argument, I believe, if we hadn't been able to persuade ourselves that we actually had made a mistake in the way we had done the computations. So anyway, that was the one big decision analysis learning from the bidding process that it was impactful, because I thought about things a little differently. You just can't go use your routine methods, without examining what you're doing.
So I'm going to ask you the $160 million question. What did you guys end up deciding to bid, and how did that turn out?
All right. We did end up deciding to make a bid. We bid at 35 cents on the dollar of unpaid balance for these loans. And that would be a very relatively low-priced pool. But it turned out that was sufficient to win the bid. And so sometime there later, we faced the second decision, second set of decisions, which was how would we go forward and exit the pool. And that turned out to be one of the most difficult decision analysis and decision professional situations I've been in my life.
Thank you. Stephen, I want to flip it to you. You're currently working with True Value Labs, as many of you have heard. Let's maybe take a second or two to describe again kind of what that is, what you're working on.
Sure. So going into detail about the current startup, we're looking to fill a void in information out there for investment managers. Our customers are people who are pension fund managers, mutual funds, hedge funds, some of the bigger wealth managers. And they care more about just the financial statements of a company. They want to know if a company's doing good, if it's going to have an impact on the planet, society. So we're sitting at the intersection of a bunch of these really important megatrends that are happening. In particular, looking at environmental, social, and governance issues. But what we're doing could extend beyond that, and we think in the long run we could look at other things like what's your litigation exposure, what's your exposure to innovation, macro issues, product releases, all sorts of different things like that. These are all these intangibles that show up in the news after a price movement, like why did this company drop 9% or why did it go up 15%? Well, you get a headline about that, and then the numbers get adjusted after that news. So we're trying to figure out, how do you get ahead of that cycle? How do you teach the computer to read what those human analysts are reading and help them to focus their time on the most important and most interesting articles to get a lot of that intangible value?
And Stephen, in the stuff that you've talked through, how are you seeing the intersection of DA and data science and helping you get there?
Well, it's the intersection of a lot of different things that are coming on here. The DA framing is what I think led to this kind of problem. I mean, other people came in thinking this is an important problem, we should be solving it. But I was looking across the whole spectrum of data that people are using in the financial area. And very few people were thinking of how to tune sentiment analysis, particularly to certain topics. There were a lot of like news analytics services that were put out for super high frequency trading. And they'd been out about 10 years, and they scored all companies. The whole document would get a single score to it and be like a buy or sell, and it would run in milliseconds. But there's a lot of nuances that are in an article, and there's a lot of different topics. So the frame of this news analytics is put it out in microseconds for the high-speed traders, and don't worry about the nuances. But when a human reads it, they're looking for those nuances. And so my old job, we'd build a credit risk model using news and company disclosures and broker research and so forth, and found that if you train your own dictionary, you can get a very different outcome from the same documents. So, for example, credit is a positive word to most people. You know, students want extra credit on their paper. But if it's in the context of a company's credit risk, credit is actually very negative, and the more they're talking about it, the worse problem you have. Taxes are typically negative to most people, maybe not the IRS. But if a company's talking about all of its taxes and how it's managing it, it's making tons of money, enough to get taxed, which narrows it down to very few companies. And they're definitely going to be paying their bills if they're paying their taxes. So you can tune this whole sentiment engine. And I mean, maybe I've let the cat out of the bag here, and other people are going to get ideas, but there are very few companies that are thinking about it that way. You know, there's a handful of people in some of the most advanced hedge funds, and you know, a few rogue data scientists, but the only two companies I had seen who were commercializing this were the one that I used to work for and the one that I work for now. And I thought, well, if I go work for a startup, I can probably get this done a lot quicker.
Great. Is there any example of the difference that your framework or approach is making that you want to get into, or?
Yeah, so I can talk about, well, another thing is how you view risk. So most people view environmental issues as risk. You've got global warming, seas rising, things like that. But there's also upside. There's people who are trying to combat these things. There's better air quality, there's reduced emissions. And you can look at an example of how companies are handling these things that may end up having similar financials. So let's take basically two-company industry. You've got Boeing and Airbus, which make the great majority of the large jets that are out there. There's the regional jet guys too. And Boeing has released all these planes with increased fuel efficiency, increased range, better air quality inside the plane, better air quality outside of the plane, lots of technological advancements. Airbus, meanwhile, has been pushing the largest thing in the sky, their giant A380, which nobody wants to fly, and they couldn't even sell it to the people in the Middle East sitting on top of the cheapest oil because it wasn't efficient to fly this thing. People are moving back to smaller planes. So their new strategy is, let's bribe government officials and get them to buy our planes, which is going to show up poorly on a governance score and social impact. So if you look at just these two companies, one is doing things to improve these externalities and being a good corporate citizen. I mean, not perfect across the board. And the other one is not, and resorting to other tactics. And if you look at the difference between these two companies, there's been a massive divergence. And you know, Boeing has been one of the best performers of the past couple of years.
Yeah, and kind of where are you guys now in terms of your True Value Labs journey?
Running like crazy. So yeah, the startup thing, we got Series A a while back. Pretty easy to raise money if you're at the intersection of these things, but you got to deliver and get the product out and get the sales going. So I really should be getting back to work soon.
Excellent. Tom, you said there were 2 lessons. You talked about the first one. Kind of what's the second?
Oh, in the bidding process, yeah. Well, I'm sure anyone who's raised capital before knows that that can be a challenging process for a venture fund or anything else. Of course, we won this pool, and the FDIC says, okay, well, here's the time schedule. 35 days from now, you need to come up with $30 million, and you need to come up with $4 million after 1 week, another $4 million after the second week, another $4 million. Well, so we're in this position of feeling like we can do good for people and make money for investors, but we haven't raised the $30 million. And so I guess the big lesson to that is don't ever try to raise a lot of money in a hurry. My goodness. I mean, the challenge is that, you know, and several people in this room were actually investors in this particular pool. You know, we're calling on all of our longtime friends and business colleagues and family members and whatnot. And when you get into it, you know, people are, you know, they're not sure, and then you're not sure if you can raise the money, and then the general partner, you know, personally we're up, you know, the first $4 million is due, or else we're in default. You don't want to be in default with the FDIC, right? I see some shaking their hands. So we general partners ended up mortgaging their houses in order to work through this and actually finally close the transactions. Fortunately, you know, we do have a lot of great friends that were very high trust level, and eventually we did pull the money together. But I'll have to say the lesson is I would not attempt to do that again in that way. That was a very difficult time.
The second lesson for everybody in the room: get better friends. Yeah. So we've talked quite a bit over the past couple of weeks and had some really interesting conversations. One of the things that kind of pops out in the conversations I've had with you guys is kind of the role values played in doing what you're doing. So I'll just toss that out there for you guys to talk about, whoever wants to tackle it first.
So in a couple different frames on value. So one is stakeholder value. You know, if you go back to some of the multi-attribute utility theory, Ralph Keeney was actually on my dissertation committee. You know, that's kind of stuck with me, that it's not just the shareholders, but you've got the people at a company. How do you treat your employees? How do you treat your customers? You know, customer welfare is one of the things we look at. We look at labor relations. We look at externalities. We look at sustainable growth and non-sustainable practices. So these are things that are not in the financial statements at all. And in fact, there's a whole organization called SASB, the Sustainable Accounting Standards Board, that has Michael Bloomberg and some other super famous people on it. And they're looking for issues that are material but are not in the financial statements. And one of the core concepts from sustainability is, what does materiality mean? It means it's going to impact the long-term valuation of the company. Mm-hmm. And if it's not in the financial statements and it's in all this text that's floating around, I mean, you have a fiduciary duty to be looking at this stuff as an investor. So then what does that actually do? How does it affect a company's valuation? So typically the way you do a valuation, you'd look at, you know, discounted cash flow or multiples or something like that. And you often find that companies are trading very far away from what that valuation should be. And we've found that these environmental, social, governance factors have a pretty strong negative correlation to value models, the Warren Buffett approach of buy something that's cheap. And the reason for that is that value loves cigarette companies, value loves coal companies, broken down industrials in Ohio, things that, you know, are historically have generated a lot of cash, but maybe that business model is changing in some way. Whereas these environmental, social governance scores aren't going to think very well of some of those companies, but they're going to reward somebody who's taking floating mountains of plastic in the ocean and putting enzymes on them and turning them into cheap drink bottles. And oh, by the way, they're trading at 400 times revenues. Well, why are they trading at 400 times revenues? Because there's this huge possibility of growth that's going out there. So you can see that sustainable investing does lead to higher sustainable long-term growth rates and lower cost of capital and so forth. So it can actually explain some of these mysteries in valuation that your typical valuation techniques don't pick up.
Tom, values?
Well, values, boy, in our context means a lot of things. It means, what's the value of the real estate where the person is not paying their mortgage? But it also has a lot to do with how do we treat people in that process, and then how do we work our way through decision quality. If I could have the second slide there. This was from, 20 2010, 2011, just from a pure decision analysis standpoint, this was enormously complicated to try to work through for the different kinds of pools of loans with different borrowers and missing information. I can't tell you how bad the data is from 16 failed banks, many of whom didn't keep very good paperwork. You had loans that are collateralized by, in one case, a herd of cattle. In another case, a loan is collateralized by high-level racehorse semen. Okay, and you get some sense of why some of these banks failed, right? Well, we inherited all these loans, right? And there's incomplete information. In some cases, you don't even have the loan documents. In some cases, you don't know what the interest rate of the loan is. Maybe you don't know what the unpaid balance is. It just, from a decision analysis perspective, it was far more than constructing trees. And this is why I'm so interested in the data science part of this whole conference, because if we had had a top data scientist at the time, which we did not, we muddled our way through, but it could have made a huge amount of difference in every respect because the data was tough. So anyway, we put together what we called exit buddy models for each type of loan based on decision analysis, so we could fill in the key decision analysis variables and get some recommendations as to which of several alternatives should be followed. And the alternatives were different for different kinds of loans and different kinds of borrowers. How do you approach them? What can you offer them? But the big distinction in what we were doing had to do with this other value, treating others well. And for us, that was a base. We wouldn't have gone into this business if we were going to do it the same way that most all the other big companies were doing it. The big hedge funds and whatnot were simply liquidating the loans, throwing everything into foreclosure that they could, getting through foreclosure as fast as they can, without ever even contacting or having a discussion with the borrower. Our role in this, as we saw it, was to treat the borrowers as well as we possibly could. So that often involved a conversation with the borrower. It often involved what would it take in terms of modified loan terms, or even in some cases doing something that the banks would never do, forgiving principal. We forgave principal in a number of cases in a way that we could still make money for investors, but that person could keep their home. So as we worked this through, we found ourselves frequently up against the time, value of time, and treating others well trade-off. What do you do if you've tried to contact a borrower 5 times and they haven't responded or they won't respond, right? So anyway, it was a very tough, challenging situation that brought higher level values in play compared to simply rolling through an analysis and trying to make the highest possible profit. And of course, our investors all understood this. It's not like any one of our investors all knew that we were planning to run the pool this way, so that was okay. Could we have made another 2% or 5% on money if we had done it the other way? Possibly. But it wouldn't have been the kind of role that we wanted to play in this situation.
It sounded like hard work.
Oh, God, hard work. Our consulting business at that time went way downhill because this just ended up being an all-encompassing, all-engrossing set of activities to work through.
Fantastic. So let's step back a little bit and talk about the challenges that you've both seen in applying decision analysis, data science, in finance. Stephen, I'll send it over to you.
Yeah, so some people used to call it decision and risk analysis. And so everybody thinks that risk is super important in finance, and it is, but we still have trouble agreeing on what it is. Is it volatility? Is it downside volatility? Is it the tail? And those tails matter tremendously. You know, we just heard in venture capital, where's Clint? You know, all your upside comes from a very small number of those situations, and most of them actually go to zero. And your risk, what takes you out? 2008 takes you out, right, when all the bad news happens at the same time. And there's a lot of broken thoughts about distributions. And I remember people, you know, there's some market crash. Oh, that was a 5 standard deviation day. And then it drops more the next day. It's like, oh, that was a 6 standard deviation day. It's like, no, it wasn't. You guys need to be updating your probability distribution. And I would do that rather quickly. And you don't have very many observations. So you've got people who are making simplifying assumptions, everything's a normal variable, and they know that it's all fat tails, and the math's too hard on that, can't be bothered with that. And so then you've got a 100 by 100 matrix with all these risk factors, including what's your country and what's your industry and what's your valuation multiple. And then they assume that the correlations are stable, which they're not even close. And then they run these things through optimizers, which tell them to load up on something that's just happened to counter some other risk in your recent test period, and there's no reason to expect that that's going to. I mean, this is heresy, right? I'm speaking against most of the CFA program, and that's who my customers are. So I'm, in a very unique position coming in from thinking about probability the way that a decision analyst would. And if you can take that and break it apart into pieces, you can come up with some interesting things. And everybody knows that the statistical stuff fails when you have a market regime change. And the quote for it is, all the correlations go to one in a crisis. So, that nice
That's
matrix
right.
you had where one risk canceled another, and that doesn't work anymore. And it's also different in different crises. Sometimes gold will save you, sometimes it won't. Sometimes real estate will save you, sometimes it won't. And if you try to build a model, these crises come once every, 8, 10 years. And if it's some new grad who's never seen a bear market, they're not even thinking about this problem. So this is where decision analysis can really step in and shine and say, what can we do? How do we construct a portfolio? Do we want to hedge this thing? And it's not binary. You don't want to be completely long one day and completely short the next. The transactions costs are going to kill you. So are there creative strategies that you can come up with? Are there new alternatives that you can create? Are there new financial instruments that you can create? Are there new trading strategies that you can come up with to try to diversify this? And there's just endless opportunities and very few people pursuing them, considering how many opportunities are out there.
Tom, your thought on challenges?
Yeah, boy. Back in this FDIC case, the mixture between the decision analysis and the financial perspectives, the pure financial perspectives, were a two-edged sword, to say the least. On one hand, we went back and showed the FDIC, who is, by the way, an equity partner in this deal. So we were the managing partner. It was our responsibility to make all the decisions for the disposition of the loans, but they were also an equity partner. So we wanted to have them on board as much as we could with what we were doing. And we went back there and showed them our exit buddy models. They loved it. They thought the idea of working with individual borrowers, taking uncertainty into account, looking at how these might come out, maximizing the values, they just loved that, right? But then we went back to them at a later time with what was a real dilemma for us in managing this pool. And that was, we were holding on to a lot of performing loans that at an increasing rate were going non-performing. Why is that? Because so many people in this housing crisis had their house go underwater, the value of their house go underwater with respect to the value of the unpaid balance on their loan. And a lot of people in that situation get discouraged and they say, well, if that's the case, I might as well not pay my mortgage. And as housing prices fell further, more and more people got on the bandwagon and say, well, the bank doesn't deserve the money anyway, or however they rationalize it, right? And even if they could pay, there's this perverse incentive in place that said, well, I think maybe we just shouldn't pay and maybe somebody will come and offer us a deal or something, right? And so we went back to the FDIC and said, we ought to hedge our risk here a little bit, and we showed them our decision tree analysis that basically said we ought to take part of our performing loans and sell them on the current market prices, and there is a good market for loans. You can buy and sell them like stocks to sophisticated investors. We ought to sell some of these. We're going to take a little hit compared to what we might have if we continued to hold them, but nevertheless, we're not going to take as much of a hit as we would if we continue to hold them and they keep going non-performing at the rate they're going non-performing, because non-performing loans are worth far less than performing loans. And the FDIC people nodded and sort of looked at it and didn't say much one way or the other, but we were actually trying to get them on board with us to make this particular decision. And their very financial way of looking at things is, well, it's the dollars in the end that's all that matters. And they couldn't figure out how to think about, even though we did our best we could to educate them, they couldn't think well about how do you make a good decision in the face of uncertainty. They wanted to judge it after the fact, and they did. And it turns out that after this, of course, we sold a number of loans in anticipation of these continuing default rates. Eventually, a year or two later, the markets came back, and the FDIC came back and blamed us in hindsight for not having made a good decision.
Well, of course.
When in fact, we did everything we could to make a good decision, and we believe to this day we did.
Okay, so I heard two things about what the difficulty and challenges were. One, it's working with finance people, which doesn't offend me as a finance person at all. The second was both of you hinted at kind of uncertainty and the way it's thought of. We've talked a little bit, I call it the great Gaussian guffaw, right? What in your minds or from your perspective is the cause of this? Like, how did finance end up where it is in terms of thinking about uncertainty and the finance dogma, if you will?
Mean variance optimization, because you could do the math in the 60s.
So I was going to say motivational bias. There's an awful lot that goes on that says it's in my financial best interest, whether the FDIC or whether you're a regulatory commission looking at electric utility, it's in my financial best interest to be able to look in hindsight at a decision and say it came out badly and therefore blame the decision as being bad, instead of judging the quality of a decision by what went into it based on what was known at the time. And for us in decision analysis, that is, and decision professionals, that is the fundamental distinction that we all know so well and that we instantly talk about. It's what Carl said changed his life today, right? But for many others, people can come from very different places, and honoring the ethic of, oh, you made a good quality decision, so that's fine, is not in a lot of people's best interests who are on the other side.
No thought.
Yeah, I mean, there's also a lack of data, because if you're going to try to assess tails of a distribution, some people try to do it with kurtosis and whatever that fifth moment is, and you need, like
Heteroscedasticity.
yeah, all these observations which you simply don't have. And again, you've got 8 crises if you want to go back 100 years, and you don't even know if those are relevant going forward. So you're going to need to interject some human judgment if you're going to figure out how to work with this stuff in the future.
Awesome. Do you guys think the history of finance is also a barrier? Like, it's a really old profession.
I don't know. I mean, there's trader lore, right? Traders understand some things that financial engineers don't. This stuff, value theory was well known in the 30s by Graham and Dodd, who then Warren Buffett followed that, and it's only recognized by academia in 1993 while I'm in grad school. It's like, oh, you guys are 60 years late to the party. It is a little hard to think through some of these things, but you can build models for them.
I think a lot of it has to do with our educational system and how we're educated. I mean, most everybody in business takes a finance class. Not everybody in business takes a probability class. If they did take a probability class, they probably took a statistics class, which is based on frequencies and past looking at data. And they don't have, well, of course, in my life, the Bayesian perspective has been a hugely positive thing. But for people that don't share that, it's just all about the factual numbers, right? And it's not as easy and clear that you should, that taking uncertainty account is just not as easy and clear as it would be for us. If I could change anything in the educational system, it would be to have universities around the country teaching some kind of Bayesian probability perspective to every single student that graduates. How much better would our world be if we could get there?
Well, and some of it's overcomplexification too, as we heard, our friend from Google this morning talking about academics reward the most complicated paper that you can put out there. In the grad school program that so many of us were in, we learned about model making, and it's better to build a bunch of simple models and see if they agree with each other or not than to build some amazingly complicated model that all is based on the same assumption. So the very first project I did as a consultant was looking at what's going to happen in the aluminum price cycle. So one is we looked at the historical historical distribution just to see where it had been. And most people don't know their market history besides what they've seen in their lifetime. Then we looked at a stochastic price process. If you did this as a random variable with these various things, what would that do? Then we did supply and demand. It's hard to hide an aluminum smelter. There aren't very many of them. And those early data scientists were out there getting stats in these things. And then there's the options marker where people are making bets on, is this going to go up or go down? And we found that 3 out of these 4 agreed, but the options market was out of whack. So there was actually a trading opportunity. And then the 3 models that agreed did predict that we were headed into this next cycle, and the company was able to take some action based on it. Yay decisions.
Yay decisions. So I'm going to pivot over to a couple of audience questions, and we'll come back. So one of the more popular ones we've got is, do you have to deal with biases in your data analysis? And if so, what tools do you use? Example of a typical bias would be good.
Oh, yeah, so that one actually came up in one of the previous talks too. So if we're looking at journalists and bloggers, yeah, everybody's got biases. Some of those biases you need, however. So someone who may have a very, let's say, liberal social bias is probably more likely to be concerned about child labor and travel to India and find a mine where 9-year-olds are pounding on rocks and getting mica and selling it to paint makers, which is going on your BMW. It takes bias to investigate some of these things, but we want to have a range. But here's where you actually want to take the tails out of the distribution. You don't want to be text binding the Onion, satire rag. There's quite a few of these things out there. There is some fake news. It tends to be more in political areas than on financial companies. But here, just more data helps overcome some of it. If some short guy's trying to post some fake news, then hopefully other people will do real research, and you can find that as well.
Yeah, biases are everywhere, and there's so many different kinds of them. It's almost impossible to categorize them all, although many people have tried. And I think one of the key roles of a decision professional is to just be acutely aware of where they might be and sensitive as to how to best handle them in that situation. In our particular case, when we were putting together the decision analysis of how much to bid on the pool, okay, my team of experts down in San Diego were initially coming in with numbers for each of these segments of loans that would have yielded much lower exit proceeds than the chart that I showed a little while ago. And under the estimates that they were providing, we wouldn't have made a bid at all on this pool because it just didn't have enough in it to make it worthwhile. And what I discovered after working with them for a while was, even though I was talking with them using all, from my perspective anyway, the right language about 10, 50, 90, and one chance in 100 that it would be less than such and such, they were thinking of all this as promises that they were making. And every time they gave us a number, they were thinking, oh yeah, so we're going to give a number that we're very highly confident that we can exceed, okay? And of course, if they're in that kind of a reward system, that's what they would do. It's a very well-known motivational bias. But we had to be acutely aware of that in order to stretch them and to say, this is not your reward system here. This is trying to help us make a decision on how much to bid. So we want the most realistic numbers you can give us if you had to bet your own money. And then we kind of worked through that process. Finally got them on board, but we would have missed the whole thing if we hadn't been consciously aware of that. And I'm sure many of you have run into similar kinds of things.
All right, so let's flip to another one. Steve, this one's pointed at you. How do you trend how the values of the investors are changing? Or do you let the investors or decision makers figure that out for themselves?
How do I see how trends are changing?
Yeah, some
of them are pretty vocal. Right, and so there's a CFA society in pretty much every major city around the world, and they get together on a monthly basis and talk about stuff. And so ESG is coming up continually. You can get invited to talk anywhere you want. Just certain things become popular, and it's not solved, right? So when something gets solved, you can move on to the next one. If we have a financial crisis, they'll all be talking about the next financial crisis.
Excellent. We've got a question here on probabilities. Since many of us who are much more from the Bayesian school think probabilities are personal, Does it even make sense to talk about stock market distributions?
Absolutely. Sure. I mean, the data tells us a lot. I just happen to be, why would I be doing that? I was reading something from Harry Markowitz the other day, and he's gone through a whole analysis that says, look, if you look at S&P 500 data, daily returns over the last so many years, there's certain probability distributions that you can show as a Bayesian are highly likely or reasonably likely to have produce that data. And in fact, the probability distributions that are consistent with producing that data are different by a factor of 10 to the 74th compared to a normal distribution in terms of likelihood, okay? So how would you possibly think about making significant bets in the market without being aware at least of what the data is telling you about the probabilities and particularly the tails? It's got to be there.
But it's particularly the conditional probability distributions. When something happens, what is likely to happen next? So you can look around events or circumstances, and a really clear one is earnings announcements, that if a company beats its earnings expectations that are set by the analysts, stock should go up. If it falls behind, it should go down. And back in the 60s, you could wait for the announcement. It took people days to place their trades, and you could get in after the announcement. But then as markets sped up, you had to be able to predict it. So if you could get an edge at predicting that event, you could really make quite a bit off of it. So the first commercial model that came out of the Starmine company, once you figured out who the better analysts are and had a better forecast, you could change what was a 50-50 event into something like a 60-40 event, or in certain rare circumstances, a 70-30 event. And Vegas was built on 55-45 odds. So if you're sitting on something 70-30 on Wall Street, you should really be using it. And again, it's hard to get people to even buy this stuff because they think it isn't possible. Well, if you could do that, wouldn't you be? It's like, well,
Wouldn't you be a billionaire?
It takes more than one person to make markets efficient.
Awesome. Tom, this was a question on your curve. Let me flip back there. The red curve shows no chance of less than 160 million, right?
Right.
Check. And the blue curve shows essentially no chance of less than 152. The means of the two curves look to be nearly identical. Why would such a subtle change cause a drastic difference in the bid?
That's a great question. And you could look at this from a certain equivalent perspective. Of course, I made the calculation and whatnot. But I found that when I was actually in the situation of being a general partner and using my own money and having raised money from family and my long-time highest trust relationships, I really didn't want to make this investment if I thought there was a probability of more than 5% or something that investors would end up losing any significant amount of money. And I felt like I wanted to be able to say that to them as part of the value proposition. We've done the analysis. The probability of losing money on this is less than 5%. I wanted to be able to make that statement. If the answer is 160 million, I couldn't have made the statement. If the answer is the curve there, I could make the statement. And so that's the difference.
Thinking about the elements of decision quality, is data science / information the most important aspect of decision making?
I thought all six were important.
Decision's only as good as the weakest link in the chain.
Framing is really big. Commitment to action, huge.
Yeah, absolutely. You can make a significant mistake in any of the elements of decision quality. I think that what's happening now with data science is that the world is changing in a way that it impacts the way we build quality into the decision chain, right? And data science has become so important because we now have so much data. The amount of data in the world is increasing exponentially, and what we can learn from it is increasing exponentially, and we have to learn from it. I think Isaac defined data science as extracting knowledge or extracting learning from data. Well, there's no amount of learning that is let's say, making important decisions, you need every bit of learning you can get from every possible source, and that's why, right now, today, data plus decisions, I think, is a great theme for this conference.
Awesome. So we talked a little bit about what interested you guys in kind of jumping into this space. We talked about some of the issues you've had, challenges. In your minds, what are the most unexploited opportunities for growth? Or best do you see data science impacting and influencing finance?
I'm going to answer it quickly because it's pretty much what I said before. I think if we can work toward an educational system that helps educate every student someplace along the line in the Bayesian or information-based view of probability, I think that would make a huge difference. I think that's the biggest unexploited opportunity.
Yeah, from an investor perspective, it's understanding the tails, the rare events. How do you find those biggest winners and stay away from the biggest losers and survive the biggest crises? It makes enormous difference in lifetime wealth.
Awesome. Thank you, gentlemen. For anybody in the audience that wants to continue the conversation, we think there's a lot of interesting opportunity here. Happy to, through the Knowledge Sharing Council or offhand in the corners, have conversations. Let's give a round of applause for our panelists.